Welcome back to The Explainer. Today, we're taking a fascinating dive into a dense, highly academic operational manual and translating it into a clear, completely actionable blueprint. We are looking at the mechanics of automated option trading. Now, if you've ever felt that emotional whiplash of the stock market, the stress of watching a position plummet and the panic of deciding whether to sell, or if you've just wondered how big institutional quants build systems that trade complex derivatives automatically without fear or greed, well, this is your masterclass.
Okay, let's dive right into this. Our source material is architected by Dr. Sergey Izraylevich and Vadim Tsudikman. And listen, these two aren't just theoreticians sitting in an ivory tower. They have decades of real-world algorithmic trading experience, and they specifically specialize in extreme market environments. Their book goes way beyond a basic how-to guide. It's a literal blueprint. We're talking about a master plan for constructing a complex, automated financial engine specifically designed for options. The whole goal? Taking the human element completely out of the equation and replacing it with rigorous, battle-tested math. To understand exactly how this machine is built, we are going to use the book's core index as our roadmap. We'll break this down into 5 chapters: strategy development, optimization, risk management, capital allocation, and finally, backtesting.
Think of these 5 steps as a highly structured assembly line. You see, we don't just jump into the live market and start throwing money around right away. First, we start with the core theory of the strategy in step 1. Then, we tune that mathematical engine in step 2, install absolutely crucial safety protocols in step 3, carefully pump in the fuel, which is our capital, in step 4, and finally run a rigorous crash test in step 5 before we ever take the machine live.
All right, starting right at the beginning, Chapter 1, Strategy Development. For this explainer, we're going to use the delta-neutral strategy as our core engine and our through-line example.
You probably already know there's a stark contrast between traditional trading and option trading. With traditional assets like stocks, what the authors call linear trading, your profit is directly tied to price direction, right? You literally have to guess if a stock is going to go up or down. It's a 50-50 shot, and you are constantly reacting to market news. But options? Options are non-linear. They are multidimensional. Your profits rely on a really complex mix of volatility expanding or contracting, the literal ticking clock of time decay, and nonlinear mathematical payoffs. In this automated system, we aren't blindly guessing market direction anymore. We're engineering a mathematical position.
And that brings us to the absolute core of our engine, delta neutrality. In the simplest terms, it's a position where the sum of your deltas, meaning your mathematical sensitivity to the underlying stock price, is incredibly close to 0. Picture balancing a heavy seesaw perfectly, so that if the wind blows a little left or right, the board barely even tilts. That is exactly what this strategy does. You effectively immunize your portfolio from small up or down price changes in the broader market. So if the S&P 500 drops 2% tomorrow, your delta-neutral machine doesn't panic. You completely decouple your profit from mere directional guessing, allowing the system to quietly capitalize on volatility and time instead.
Now that we have our delta-neutral engine conceptually built, we can't just drop it into the live market. We have to tune it. This brings us to Chapter 2, Optimization. Now, what's really interesting about this correlation data is how it demonstrates multi-criteria optimization. Instead of just looking for a single variable, like maximum profit, the architects map out how different goals interact with each other. For example, how does your overall profit correlate with your maximum drawdown, which is the largest drop in your account value, over different historical testing periods? It proves you absolutely cannot just optimize a system to make the most money in isolation. If you do that, you might accidentally optimize for a system that eventually blows up your entire account during a highly volatile month. You have to balance multiple, sometimes conflicting, mathematical criteria to ensure the system is genuinely stable.
But balancing those criteria leads to a massive hurdle, the optimization trade-off. The authors highlight this constant battle between minimizing your calculation time and maximizing your information reliability. Think about it. If you try to test every single parameter variation to find the absolute perfect golden setting for your strategy, you are going to quickly run out of computational power. The market simply has infinite variables. System builders have to make calculated compromises to tune the engine efficiently, getting maximum reliability without wasting endless computing resources on impossible perfection.
Okay, engine is optimally tuned. Now we need brakes. We need unbreakable safety protocols. That takes us to Chapter 3, Risk Management.
Because options are nonlinear, you can't just tally up your risks like you would with a handful of normal tech stocks. We face some very unique challenges here. Specifically, tracking option metrics known in the industry as the Greeks.
Think of the Greeks as highly sensitive mathematical sensors measuring entirely different dimensions of risk. Delta measures price direction speed. Theta measures time decay. And Vega measures volatility. A static safety net just doesn't work. You need a specialized, highly reactive set of these multi-criteria risk indicators running simultaneously just to keep a complex delta-neutral portfolio safe from sudden, catastrophic market shocks.
Engine built, tuned, safety protocols online. Which brings us to Chapter 4, Capital Allocation. How do we effectively pump fuel into this machine?
And this brilliantly illustrates a core philosophy of the authors when it comes to that fuel. They argue forcefully for a portfolio-level evaluation rather than element-level evaluation. Element-level means looking at individual options completely separately. But in a complex strategy, if one option is temporarily losing money, it might actually be serving as a necessary protective hedge for another option that is currently gaining. Viewing the entire interconnected web of options as one single entity, the portfolio level, creates less aggressive, far more diversified positions. It keeps the whole delta-neutral machine balanced rather than panicking and over-revving one single faulty part of it.
We have now reached the final and honestly perhaps the most critical phase before going live. Chapter 5, Backtesting Option Strategies. This is the rigorous crash testing phase.
You can't just look at past charts and assume your system works. The authors outline a strict, automated framework. Step 1, curate a pristine historical database. Step 2, generate mathematically sound entry and exit signals. Step 3, model real-world order execution, and yes, that includes the harsh reality of broker commissions and low trading volume. And Step 4, run a walk-forward analysis. This means testing a strategy on a small chunk of past data, stepping forward in time slightly to untested data, and testing again. This entirely prevents the absolute biggest threat they warn about, overfitting. Overfitting is literally like memorizing the exact answers to a practice test. You look like an absolute genius until you sit down for the real exam, and then you completely fail. You cannot tweak your parameters so perfectly to past data that the system just shatters in the unpredictable live market.
So the crucial point here is really a synthesis of these 5 steps into one unified philosophy. Options demand portfolio-level management. You simply can't trade them in isolation. Because they're nonlinear assets, they require specialized automated logic and multidimensional risk sensors. Our core engine, Delta-Neutrality, completely decouples our profit from the stress of mere directional guessing. And finally, backtesting has to rigorously and relentlessly use techniques like walk-forward analysis to avoid that catastrophic trap of overfitting.
If you want the ultimate TLDR for this entire operational manual, it really comes down to 3 foundational rules. 1. Discard traditional linear trading logic. 2. Build a comprehensive nonlinear portfolio system. And 3. Test rigorously to survive the harsh realities of the live market.
It is just a completely different way to view the financial world. It replaces raw human emotion and guesswork with pure, unapologetic algorithmic discipline. So I'll leave you with this final provocative thought. Are you ready to stop guessing market direction and start building your own market-neutral algorithmic machine? Thank you so much for diving into this blueprint with me today on The Explainer, and as always, keep learning.